All right, so this video is an exciting one. It's basically, we're going to be talking about how much does an Amazon FBA business typically sell for? And there's a lot of variables to this, and there's a lot of different insights that we're going to try to glean off of Ryan Condie here, who is a M&A advisor, specifically does a lot of business with FBA businesses, helping them sell, helping them get the best multiples. So Ryan, right off the top, like, what is a multiple? How is it determined? And we'll start with the basics, and we're going to work up to the more sexy questions as we keep going. All right.
That's awesome. Yeah. Thanks, Eric. So first, let's start with a multiple, right? So when you think about a business, how we're gonna value that business, right? We work off a couple different things, and this is the standard practice with online businesses. We use a term called SDE, or seller's discretionary earnings. It's essentially your net profit plus your owner benefits that are going to be added back, or one-time expenses. And it could be your cell phone bill, or that trip you took to Hawaii, but you didn't need to take that trip to Hawaii. You just wrote it off because everybody likes to pay less taxes. So we need to determine what your seller's discretionary earnings is, and then you're going to receive a multiple on that. So we take your trailing 12 months, and then from a multiple perspective for Amazon FBA businesses, it can be anywhere from, say, a 2x or a 7x. And for simple math, Eric, let's say your business is doing $300,000 a year in profit, or that SDE number, that seller's discretionary earnings. You're probably going to be in that like 3x range, right? A 3x to a 3.5x. What that means is you take that 300,000, you're going to multiply it by 3, so you get 900,000, and then we're going to add the inventory on top of that. So that's considered your multiple. And that multiple, we're going to go through some factors right now of what determines that multiple, whether you're higher, whether you're lower, and what that goes for. The other thing I want to point out too is when you think about Amazon FBA businesses, and a lot of people will throw out multiples and they'll throw out this and that. We like to separate inventory separate from the business, because the inventory that number will fluctuate often, especially with the seasonality that we were talking in the previous episode. Sometimes you're going to have a lot of inventory, and sometimes you're not going to have very many if it was just your peak season. Since that number fluctuates, we like to say, hey, here's your multiple on your business, and your inventory is separate, because that will fluctuate over the next few months as you look for your exit.
Okay. And then just kind of circling back to, as far as you were talking about owner's benefits. So like, let's say you're selling a business and it's like $100,000, but you did go on a $10,000 conference to Hawaii, right? So basically what you're saying is that would get added back in, and really it's $110,000 of SDE is the way you'd look at that. Am I understanding that correctly?
Correct. Yeah, most of the time, Eric. And it's got to be something that's not repeatable, and it's something that didn't really add to the business. If you went to a conference, or say you went to a trade show and you actually picked up clients there, well, that's actually not going to be an add back, because you went to that trade show, you picked up clients. It was more of a marketing activity, right?
Okay.
And the thing we see it over and over again, is people get really fancy of not trying to pay too much in taxes. It's a dangerous road to go on, because you do that too much, and you can only have so many add backs without drawing the evil eye from a buyer or from a lender.
So that's actually a good point, though, because if somebody's watching this right now and they're thinking, I might sell in a year, maybe you might want to reconsider that random trip or that random thing that you're kind of doing as a owner's benefit kind of thing.
Yeah, that's exactly right. You want to prepare now, and people will do a lot of odd things to save a few percentage points on their taxes, but then get hit on the more important thing when they're multiplying that by a 3x or a 4x when they look to exit.
Yeah, that's a good insight there. As far as the typical multiple, because you were saying, all right, $300,000 business, you might be looking like 3.5x. How has that number changed over the years? Like, what have you seen? Because I know obviously we've had a big change in 2020 as far as e-commerce goes. How's that number changed?
Yeah, and let me go through some stages here, right? So up until about 2020, most Amazon FBA businesses were typically trading anywhere from, say, like a 1.5 to 2.5x, right? And what that meant is...
Seems like blasphemy now.
Yeah, absolutely, right? There was a lot of fear around Amazon, whether Amazon was still going to be around, or whether they'd still have third-party sellers. Well, guess what? Amazon's still around, and they still allow third-party sellers.
Is this electronic commerce still going to be a thing in 2 years?
Yeah, exactly. The internet's still around. There was a lot more fear around Amazon years ago than there is now, and people have accepted that risk. And Amazon is a strategy that every e-commerce player, and really any online business, has to have some sort of Amazon strategy for. So it was about 1.5 to 2.5 before that, and then hit 2020, and in between 2020 and 2022. There was a lot of frothiness in the market. People are familiar with the aggregators. There was billions of dollars raised, and a lot of these companies went after Amazon FBA businesses because they were a little bit easier to run. They had 3PLs already set up in the Amazon fulfillment centers, and we saw those multiples start to scale up pretty significantly into 3x, 3.5, 4x, and depending upon the size of the business, we've seen 7, 8x exits, right? And an 8x exit compared to 3x exit, you can do the math. It's almost 3 times the size. Now we fast forward to 2022. Those numbers have started to slow down a little bit. You know, a lot of what we see in this market has the same sentiment of the general stock market. So if the general stock market is positive and happy, multiples are going to be better. If it's not positive and happy, you're going to see those multiples come down a little bit. Or if you're going to see interest rates go up, which, you know, they've gone up in 2022 towards the end of the year, they've gone up significantly from, 12 months ago. All those things will have an impact on it. I would say generally most Amazon FBA businesses are typically going to fall between like a 2x and a 4x for a multiple. There are exceptions, and we can kind of talk about those. And one of the main exceptions here, Eric, is going to be just the overall size of the business. You know, if you are only making a few $1,000s a month, or sorry, a few $1,000s a year, it's going to be a really low multiple. You're not going to get much for your business. But take, for example, a business doing $1 million a year or $3 million a year in your SDE. That's a much more stable business. You have systems, you have processes. It's just a bigger business and less risk for a buyer. And so naturally, the bigger the business, the higher the multiple. You see that in the stock market. You know, the bigger the business, the higher they're actually trading for from a multiple perspective.
So the rich get richer on Amazon too.
That's exactly right.
As far as that, so it's interesting knowing that the size has an impact, but like, how is the multiple figured out if you were to actually break it down, like in the nuanced steps of that? Like, what does that look like when you're like, because I know right now, like if people want to check this out in the description, there's a link where you can get a valuation of your business for free from Quiet Light. That'll get actually attached to Ryan, and you can talk to him off of YouTube. But how is that multiple figured out? Like, what do you guys do when you're doing a valuation?
Yeah, and that's a great question. So a lot of times we're going to go off of the financials. So those are an important piece that we can't miss, right? You can't deny the financials, right? But how do you get to that multiple? If the financials are the same, what's the difference between a 2x and a 4x, and how do you get there? And we use something what we call the 4 pillars of value. And essentially what the 4 pillars of value are going to be risk, growth, transferability, and documentation, okay? And this is applicable to not just Amazon FBA businesses, but to all businesses, right? Risk is going to be, are there certain dependencies within the business or restrictions? Are there certain categories that you can't sell on other marketplaces, or can you not use Facebook ads for different categories? And a critical piece on the risk is the overall trends of the business. If your business is going up, you're going to have a much higher valuation. If your business is growing, it's obvious that you're going to have a lot more interest from buyers. As the business is growing, buyers are going to see this as a quicker way to get back their ROI, right? Their return on their investment within buying your business. Now, if your business is stagnant, you could still sell a stagnant business, but your multiple is not going to be as high. And then, of course, as you think about a business that's actually declining, it's very obvious. People are going to pay a lot less for that type of a business. So I would say trends are one of the most important things, and it wraps up into those risks. Growth. Right. Do you have existing growth built in? Do you have products, marketing optimization, new products that you could launch? All those things are really tied to growth. The third piece, which is a little less relevant to Amazon FBA businesses, but it's more transferability, right? It's not, is your business built on personal branding or personal relationships, or do you have poor processes in place? Most Amazon businesses have outsourced the difficult part of fulfilling orders, which is what Amazon Fulfillment does and FBA does. So they've been able to fix that. And the fourth and critical piece here, though, Eric, is documentation, right? So do you have clean and well-kept financials? Are you doing your books on an accrual basis, not a cash basis? We could dive further into that if we need to, but those are the important pieces, such as standard operating procedures, that if you have those, it really can be a game changer from taking your business from, say, a 3x to a 3.5, or a 2.5 to a 3x. All those pieces will you create this cocktail mix. And sometimes if you've got too much of one thing, like in your risk, or if your growth's not doing very well, it can actually change the entire cocktail and doesn't taste very good.
How often do you find the documentation to be pretty subpar when you're doing this analysis of a business? Because I know personally, like, that's the last thing I want to do. Like, I want to create, I want to build, I don't want to document.
Yeah.
And the reason I'm bringing this up is like really trying to like twist that knife for people listening that might not have good documentation to understand, like, look, you might be getting 5-10% more on the sale if you have that documentation, whatever the number might be. But like, what are your findings from talking to people? Like, typically, what does the documentation look like?
Yeah, and it's hard to put a specific dollar amount, like, hey, if you have good documentation, you'll have a 10% increase on your sale, because it's all over the place. It's hard to give it a specific number.
Yeah.
But the transferability, you're going to save a lot of time on transferring it, and the marketability of your business. And if you think about this, the size is a critical piece. Like the bigger the business, the more processes they'll have, right? They're going to have standard operating procedures. And so you can sort of wing it at the beginning in a certain size of business. But, when you start doing millions a year in revenue, it's not something you can wing anymore. Or if you've had to bring VAs or employees on board, you've got to have them create those processes or create the processes for them. So a lot of times, you can wing it to a certain level. But at the end of the day, everybody thinks standard operating procedures are for the buyer, and they are in a sense. But if those are created now, you'll find inefficiencies within your own business, which will improve your business in the short term as you're owning it and running it and paying yourself and have more profit, which therefore leads to a better exit down the road too. So it's not just like let me do this for the buyer. This is also something that's going to be critical for you as an operator within the business.
Yeah, and I would imagine that documentation, it would kind of bleed into other things, right? Because if I was looking at buying a business, I would say, well, there's less risk because of the documentation, because if this pivotal person were to leave, it's a lot easier to replace that person and get them into the system. It's just, I would think it would add a lot of comfort to the buyer knowing that there's that documentation in place. One of the other things too, how does the number of SKUs impact the risk factor? Let's say somebody's got one product or they've got thousands of products. How do buyers tend to look at that, and how does that impact the overall multiple?
Yeah, that's a good question. Let's talk about SKU count. SKU count has the way buyers perceive it has changed over time. It used to be that people liked a lot of SKUs, and now it's pulled back that people like very few SKUs. But the problem with, if you only have one or two SKUs and they make up 80% of your revenue, there's a lot of eggs in one basket, and it can be a little scary for buyers. I don't know what the healthy mix is, and it's very dependent upon your product mix and your categories that you're selling in. But I would say anywhere from 15 to 30 SKUs is the right amount. Have we sold businesses and helped entrepreneurs that have 700 SKUs plus? Yes, absolutely. But if you think about all the different moving pieces and how much inventory you need on hand and just the different things you have from a buyer perspective, it makes it that much more difficult. And so there's a healthy balance, and it makes, what's best within your business and within your category. And some businesses like apparel, you talk about, if you have 5 different sizes and 5 different colors, all of a sudden you have 25 SKUs for one product. Whereas if you don't have sizes and colors, then you only need one SKU. So there are some categories where you're naturally just going to have a lot of inventory and a lot of SKUs, but that's changed over time, and it's hard to put a hard and set rule. There are very experienced Amazon buyers and Amazon operators who are okay with high SKU counts. And sometimes that actually gives you the ability to diversify from somebody else. And other times people are like, hey, I just want my 5 or 6 SKUs, and I don't want to have to think about 700 SKUs that are out there. Usually when you get above, really 50 or even 100 SKUs, it starts to get really tricky. And there's a lot of moving pieces. The buyer's going to need some good systems in place. And most buyers who are interested in something that's got 700 SKUs, they're going to have an e-commerce background. They're going to run 5 other Amazon FBA businesses, and they're going to plug this into their inventory management system and everything. So as you get higher and higher SKUs, it does reduce how many buyers are going to be interested in the business for sure.
What would your advice be to somebody who maybe has several FBA brands and they're like, that's it, I'm out, right? And like, let's say they have 5 different brands. Between the 5, they have 200 SKUs. Would you recommend them to sell that as a package, or would you recommend maybe that it would be better for them to not sell it as a portfolio and split them off? Like, what's your experience with that, or maybe off the top of your head, what do you think?
Yeah, good question. We run into this a lot, and it's hard to tell because if you have one brand that's not very big and one brand that's crushing it, the brand by itself may not be worth that much, and so it's easier just to bundle it as a seller to put it all together because they may not have another buyer for it. One thing that's critical here, though, Eric, is we want to make sure is you don't want multiple brands selling under the same seller central account. So you actually want to split those apart. And the reason is sometimes buyers only want one of the brands, or a seller may only want to sell one of their 4 brands. But it used to be buyers would want to buy the listings, but not the seller central account. And they'd go create their own seller central account and merge those listings over, take over the trademarks and everything, and that is not the case anymore. So if you have multiple brands in one seller central account, you do want to separate those, and you want to give that time to marinate, right? Buyers won't take on that risk anymore. So it's not something you can make the switch on a Friday and try to sell it on a Monday. You really need to make that switch, let it run for a few months, make sure there's no issues, And it'll make it much cleaner from your financials. It'll make it cleaner for your taxes. It'll make it cleaner for the buyer who's then trying to finance the business. You really do need to separate those. You can sell portfolio companies, but a lot of times those portfolio of companies are not in the same categories. So you may not have the same buyer who's interested across categories.
Okay. I have one last question. So one of the things that have come up a few times is brand. And it's kind of that airy-fairy thing of like, how does that impact a price or, a valuation? Are there actually any tools or resources that you use to decide like how much brand equity a certain brand might have on Amazon? Like, I know like I'm a content guy. I can use SEO tools to search brand, keyword searches and stuff like that. Do you guys do anything like that, or what's your experience with that?
Yeah, that's a good question. It's hard to determine the value of a specific brand. And there are people who have strong brands on Amazon, but a lot of times,
if you ask the owner, the brand, it's huge.
But
Everyone's talking about it.
But if you think about your own buying habits, a lot of times you're going to Amazon not specific for a brand. You're kind of like, well, I need this widget, and this one has the most reviews. So I would say there's more emphasis on reviews, more emphasis on just the overall listing and the structure of it, and making sure that works well, right? And I think. One of the pieces we haven't talked too much about this, when you think about multiples and just your general Amazon FBA business, is you as a seller, right? Do people want to work with you? Do people trust you? Do people like what you've built? Are you nice to work with? All those factors come into play, and we've worked with people who are not very nice. Well, guess what? Buyers in return aren't very nice, right? So those are all these factors where at the end of the day, you might be selling on Amazon, but you're still building a real business. You're building a good brand. You're building good listings. You're building a good product that's unique and it's diversified from everybody else in there. And all those critical pieces come together to make what you do work, right? There has to be some point where there's magic somewhere within your business, and that magic needs to be able to transfer to a new owner. And once you can bottle that up and transfer it to a new owner, then a lot of these things that people have fears about are reduced significantly.
All right. So documentation, do it. You don't want to do it if you're watching this.
Yes.
Maybe I'm speaking to myself, but last thing though, I wanted to ask you about is like, how do you think about like leaving a little bit of potential upside in? I know I've heard it called like powder in the keg. Do you want to leave a little bit of upside in the business, or do you want to like optimize and take everything out of it that you possibly can, and just drip every ounce of juice out of it so you can get the best multiple? How do you think of that?
So that's a great topic, and it comes up a lot too, Eric. I'm glad you brought that up. So everybody thinks about, I need to try this, I need to try that, or TikTok is working, or this is working and that's working, right? It's very difficult for a small business owner, especially online, whether it's at Amazon FBA or not, this is applicable to everybody, to be good at multiple things, right? A lot of times you start out good at one thing and then you slowly branch out to the other things. The problem with not leaving any powder in the keg is there has to be some meat left on the bone. There has to be powder in their keg left for a new owner. And if you don't do that, well, why would they buy the business? Nobody buys a business to keep it the same size. They buy a business because they think they can grow it, or they want to grow it, or whatever that might be. So that's a critical piece. And if there's an area of the business that you're not good at and you're not willing to hire someone who is good at, I usually say it's better to leave that as an opportunity for the new owner, because the new owner doesn't know if the business doesn't work in that setting. And a clear example is you're on Amazon and you haven't taken it to Shopify. It might be that you're just not good at Shopify and you're not good at getting traffic to Shopify, or it might not be because your product actually doesn't work over there. A buyer is just going to assume that you rolled it out perfectly and you didn't do a good job. Right? That you rolled it out perfectly and then the business doesn't work on that platform. So that's an extreme example, but you have to keep in mind you can't possibly do everything. So it's almost better to leave some meat on the bone. And, this is as you're getting closer to sell too. You don't want to make big capital decisions that are going to take, 12 months, 18 months, 24 months to realize any of the gain there. And a clear example is, if you're looking to sell the business in the next couple of months, you don't want to go spend $50,000 and redo a whole website, because it actually might make your business worse in the short term, and you may not be able to recoup some of that investment. And that new owner may want to take the business a completely different direction. So there's all these different pieces where you want to make sure you're timing your own rollout smoothly, but also leaving some left on the table for the new owner so they can continue to grow the business.
Okay. I like that answer. What we want to talk about next is, so we just talked about how you actually formulate that multiple. Where does it consist of? But how do you increase your Amazon FBA multiple? So this is going to be a really fun video. It's on the screen right here that you can check out, and we're going to get you in that next video.